How's it going, everyone? Jareem McKee back again, full-time employee, part-time real estate investor. I just wanted to come and give another message. If you're watching this right now, we're in the heart of the coronavirus pandemic, and I'm sure that you're worried about 401k plans. I'm sure that you're thinking about how the stock market has been fluctuating up and down over the last several months. And I just wanted to take the time to show you why I personally believe that real estate is a much more lucrative and even a safer investment over the long term than stock investing would be. So please stay tuned. Hopefully I can break this information down as simple as possible. And as always, if you have questions, please comment below. Thanks. All right, guys. So as mentioned, I'm going to try my best to explain to you why real estate investing is better than stock market investing. And before we start, I just want to make things very clear that when I talk about stock market investing, I'm talking about index funds, mutual funds, things that tend to mirror the market in total. I'm not referring to individual stocks because I know you can make a lot of money if you know what you're doing, but I'm concerned about the average investor. And on the real estate side, I'm not necessarily talking about single family homes. I'm more focused on small multifamilies, the duplexes, the triplexes, the quads, that sort of thing. So not saying that you can't get these same good returns with single family homes, but I'm always an advocate for the small residential multifamilies. So to prove my case, I'm going to start off with a $20,000 investment on both the stock market side and the real estate side. And we'll just go case by case and see which one looks better. But I want to make something very, very clear. I don't think the stock market is bad. I have money invested in the stock market. I don't see any problem with the stock market. I just believe real estate is better. So if we start with the stock market and we use our $20,000 as our initial investment, we're going to have some assumptions. One is that we get 8% a year in average return, and that's pretty consistent with what a lot of experts say. Although I don't fully buy it, I know that that's the general consensus, so we'll run with that number. Now, we're also going to assume that we're holding these for the long term. So we're using 30 years. We'll pretend that you're 35, you dump the money in, and you don't plan on touching it until you retire at age 65. Now, I'm going to show you how that $20,000 investment could actually turn into over $200,000 in net worth by the end of that 30-year period. So let's look at the numbers. So if I start off with $20,000 as my initial investment, what happens is every year I'm making 8% on that money. So in year one, I've actually grown my account by $1,600. Well, the very next year, I've got $21,600 to then apply 8% to. And that's how compound interest works. So every year thereafter, my base is larger, therefore my return will be larger in terms of dollars. If we fast forward all the way to year 30, you'll notice that we're looking at over $200,000 in our net worth or in our portfolio that has grown from $20,000. So you'll see an increase of over $180,000 over the course of that 30 years. And that's huge. That's why I say that stock market investing is a good thing. If you look at this curve, that's great growth, right? But I do believe that real estate is better, and I'm going to show you why. So leverage is one of the main reasons. If you think about spending $20,000 to invest, if you have $20,000, you can only buy $20,000 worth of stock. Versus if you have $20,000, you can actually leverage that money and buy a $100,000 house. That's huge. The next issue is cash flow. So on the rental side, you actually get monthly cash flow if you buy the property right and you manage your expenses right. That's different than real estate, than stock investing, because even the returns that you make, you technically have to keep those invested in the market in order for the compound interest to really take effect. So the cash flow allows you to be more liquid. You can spend the money, you can reinvest the money without really impacting the value of the home, which is the asset in the long term. And lastly, you have appreciation, which will greatly benefit you over time because the average appreciation rate on homes is 3 to 5%. So that value is steadily rising. Your net worth is growing. You don't necessarily have to do anything except for ride the wave of the market. So we'll take the $20,000 and use this in a rental example. Let's say you buy a $100,000 duplex with that $20,000, and we'll assume that it's in rural Arkansas or rural Texas where the rent is low. So we'll just imagine that the rent is $633 per unit. Well, overall, you'll be making $1,266 a month in rent. But then you have to factor in your expenses. And so part of your mortgage, which is your main expense usually, is your principal and your interest. And we'll assume that that's about $400 on a 100K property. Next, you have to calculate your operating expenses, and that's usually safely calculated by using the 50% rule, which just says your operating expenses are about half of your monthly rent. So I've used that, and I've actually added an extra $100 to that just to be extra conservative. And those operating expenses consist of, capital expenditures, vacancy credit, so that if someone does leave, you're prepared, property management expenses, so on and so forth. Now, if you calculate all of those, you come out with $133 a monthly cash flow. And what that means is you'll receive $1,600 a year in cash flow. And if you notice, that 8% cash on cash rate is identical to the 8% rate of return that we're using on the stock market side. And I did that very purposefully because I want this to be as close to apples as possible. I actually think that you can get above 8% cash on cash on most deals if you know what you're doing. So guys, just a quick side note, if you ever need a calculator to help you generate these cash flow projections, download the HouseQ app, because that is where you can download one app, calculate any cash flow figure in the palm of your hands in a few minutes. And it's something that I'm really proud of. So if we take those assumptions and we just say $20,000 investment buys a $100,000 property, 8% cash on cash. Now we'll factor in some other assumptions such as a 3% rent increase, which is pretty standard. 3% appreciation rate, which is actually on the low end, but that's pretty standard as well. And again, we're going to consider 30 years of growth. If you factor all of those things in, you're actually going to grow your net worth by over $400,000. Again, these are our projections, but we're very, very conservative with our numbers. And so if you take the same example, that $20,000 after 1 year has actually grown to $21,409. And that's because of leverage. So you've got principal that's being paid down from your loan, and that is being added to your net worth. As well, you've also got cash coming from cash flow from the rentals. And if you're saving that cash, then that's growing your net worth. On top of that, you've got the appreciation at 3% of the $100,000 asset that you bought. So if you look at the end of year one, you've already grown your net worth to $26,000. Now, if we carry that assumption forward, by year 30, you're looking at $424,000. And that's all because of the leverage. That's all because of the cash generated from rental income. And that's all because of the appreciation. And if you look at that curve, that's substantial growth over that 30-year period, all from a $20,000 investment. So let's compare them apples to apples, side by side. So if you talk about the stock plan, yeah, you're making good returns. You've got your $1,600 gained after the first year. But on the real estate side, you've gained almost $5,000 after your first year. So then if you go down to year 30, what we're looking at is a huge difference in actual growth of your asset base and growth of your net worth, because you've got the added bonus of leverage, cash generated from rental property, and appreciation. Whereas on the stock side, you only have the compounding interest that's building up your cash, but you have to keep that cash invested in the market. Otherwise, you won't get that benefit of compound interest. So if you see those two curves side by side, it shows you that, if you do this right, real estate on average could provide you with way more upside than stock market investing. And again, these are all based on kind of well-known averages. We're not veering off of the general consensus right now. One last thing I want to touch on is the retirement spending available for both of the different methods. So on the stock side, there is a rule that's called the 4% rule. And what that means is the total value of your portfolio shouldn't ever be taken out. Otherwise, you won't be able to sustain your amount of spending over the long term. But the 4% rule says that you can take out 4% of your portfolio's value every year for spending money, right? And essentially, if you do that, the interest that you gain year over year should offset it and you won't run out of money. Now, that's the thought process. But if you only have 4% available to remove from your $2,000 portfolio, then you only are allowed $8,000 a year in spending. Now, on the real estate side, the beauty is that over time, because you've been increasing that rent, your cash flow after all your expenses are paid has already reached $12,000 at the end of year 30. And after year 30, once your mortgage is completely paid off, you're only paying property taxes and operating expenses. So your actual cash flow jumps up even further to something closer to $16,000 a year. And if you look at these formulas, 4% of 200,000 versus rent of 35,000 in year 30 minus 19K in expenses, you'll see that the yearly spending is even doubled what the stock market would allow you to spend if you're talking about real estate. So that's the beauty of real estate investing in a nutshell. Guys, I just wanted to prove this case in as simple of terms as possible. Again, I don't think either way is bad. I'm invested in both. So by all means, just do whatever you want to do, but be very smart about how you do it. Do your research. And if you ever need some tools, go to houseq.com. We'll provide you with learning and we'll provide you with tools that would help you calculate deals. Thanks again for your time. I appreciate it.